Mike, good morning again. How are you, buddy?
Good morning. Doing fantastic. How are you?
I'm great. I am excited. It feels like it's been a little while since we've done this. I know it hasn't been. But today, again, it's a special episode, just you and me. We're going to bring guests back, I think, next month. So
just a little bit of, have the guest, have us. It's dangerous, though, Michael. We've talked about this. When it's just you and me, this might turn into a 2-hour-long show. Who knows?
Our producer right before this was asking how long this was going to go. And we made the comment that normally we have we talk about this and we go, all right, this is going to be a 30 to 35 minute show. And we have not hit that time ever. So we will try to keep this one as compact as we can. We don't want to have people dropping out or flipping on Netflix at the end of this. So. Okay, so today I'm gonna do a little more of the asking. Last time we spent a lot of time on conference season and talked about why we find certain events so useful throughout the year. It's fun. That's getting more real. Like we're about a month away from the first RIA Edge event, and I got an email today on the Wealth Management Edge event. So we're starting to get closer to actually being at some of those conferences. But this month, we thought it would be a good idea to maybe unpack one of the phrases or scenarios that we've talked through quite a lot. So both you and I have made mention of the magic number 7 and why we think that is integral or vital to securing your largest enterprise valuation. So today, we thought it would be a good idea to talk through why that is. What do we mean when we say you need to think through this 7 years before you're going to exit? Why is that important? What are you leaving on the table if you don't take that into account? And then more importantly, let's break this into more bite-sized chunks. So before we kind of dive into each of these buckets that fit the 7-year time frame, do you want to maybe just kind of walk us through what we mean when we talk about 7 years?
Yeah, and I think 7 years in general, it could be 6, it could be 8, right? But when we're talking to a lot of advisors, what we found is that generally there is this time period, it's about 7 years, leading up to whenever you want to do a transaction with your firm. Every advisor at some point is going to go through their liquidity event. They're going to require a liquidity event at some point. And what we have found is that when you start to think about that process, think about what state you want your business in, what type of succession plan you want in place, in general, how you want your transaction structured. If you start looking at that 7 years out, we'll kind of get into the details of why, tends to work out better for the seller. They tend to have a better time. They're more prepared for it. They've done their research. So in general, that's what we're talking about here is that when you are looking for that next phase of life or next, phase of your career, looking at it 7 years ahead is going to prepare you the best. And I think you are going to be the happiest post-transaction with how everything turned out. And I think one general way I'll summarize it, Michael, is what my goal is. And one of the unique things about my role here at Carson is for the longest time, up to a few months ago, I was working with our advisors who were on platform. So they were here, right? So I formed a really good relationship. A lot of them, I helped them onboard when I was on the legal team 8 years ago. And then I've seen them kind of go through these phases of life with their career. What I always tell them is my goal for you is that all of the options are on the table. We talk a lot here at Carson about finding your freedom, right? Freedom to me comes from you're not limited in what your options are for what this sale looks like because you kind of were low on time, right? 7 years, make sure that all of the options are on the table. That's really, I think if I were to summarize it, that's why I kind of look to the 7-year timeline because it really doesn't preclude any of your options in terms of a sale. And we'll get into more of those details here in a bit.
I think that's a great way to phrase it. I mean, really, we're talking about a bell curve, and it's both optionality and peak valuation. So yes. If you are more than 7 years away from your planned exit, you might have a little bit less buyers at the table, depending on the way that your practice is structured, because they know that there's going to be the expense of having you and your team and your staff around for a long, long time. Likewise, if you plan on exiting right before or right around the time of a transaction, then a firm like Carson is going to have a hard time feeling confident in the growth of your firm because your firm is inherently less valuable with you in it.
Yeah.
And so I think if you think about it that way, I like the way you phrase that. It's not that you have to do this at 7 years. It's more around if your goal is to secure optimal funding and valuation credit, 7 years is when you should start the process, not transact, which we're going to get into in a sec, but that's when you start this process.
Yes. Yeah. Think of it like you're selling a home, right? If I'm going to be selling my home, there are going to be some things that I'm going to need to do in the years prior to selling it, right? I'm going to start fixing up those little things that, I've been ignoring for a while. I'm going to do some touch-up paint. I'm going to be doing a lot of market research, doing some comps, seeing what other houses like mine are selling for. I'm going to kind of trend that, over a period of time and be looking at those sort of things. It's very similar, right? You want your house in order. And if we think about it, we've spent a lot of time on the show talking about what drives maximum value. And what drives maximum valuation is a firm that is in their peak growing years, right? Their trend for their growth is still going up. It's not falling down or stagnant. It is a firm that has succession built in. They have a full team where when that owner steps out, ideally the buyer's like, great, this thing's going to continue to run. Right. It is a firm that's very profitable, right? Your margin has gone up. So you've gotten to a size and a scale where your margin is starting to expand. Those are a few of the things that, so if that's the goal, right? If our goal is to have our house in order and to have a really profitable business, we start thinking about that 7 years out. It gives us time to make corrections and do little tweaks to have that end goal in mind. The other thing I'll mention is that, typically when I've been talking to a lot of our partner firms, there's a lot of options for succession. There's, hey, I want to, if it's really important to you to sell to someone in your own business, right? Some owners say, hey, I really want to sell to that next
This is
gen.
a good point of clarification.
Yep. And so but do you have that person in play? And would they be able to write you one big check or do the type of transaction you want to do with that next gen advisor? Or is it going to require them to kind of buy in chunks over a period of time? So that goes back to my point of not leaving any options off the table. If you start looking at this 7 years out, you might start to find that, hey, I have a next generation advisor. They're already on the ownership a little bit and their plan is to buy me out. That's likely at today's multiples and interest rates. That's likely going to take, several years to accomplish, if not about 10 years.
Yeah.
So waiting around
might
might eliminate that as an option.
You're exactly right. If it is an internal transaction, 7 years might not be enough. It might already be too late. And in all likelihood, it is verging on the too late at today's valuation. So I'm glad you brought that up. I think that's a really good point. And we actually talked about that. We did an episode a while back on the rise of the institutional buyer. Why do we see so many folks turning to a firm like Carson rather than selling internally? And that was in large part what we discussed, which is the math problem around a G2 advisor trying to buy in without the runway to fully amortize the value of the practice over oftentimes more than 10 years, or a great deal of risk being taken by the seller and having them finance it themselves.
Yeah, so going to an institutional buyer allows for that other owner to buy in as much as they are comfortable with, and for the buyer, the institutional buyer, the Carson of the world, to fill in the remainder, right? And with rollover equity and a lot of those things, we can accomplish the same goal without the seller having to give up value, like sell at a discount or, take their money over a much longer period of time if they were doing the transaction that way. So again, going back to just making sure all your options are on the table. The second option would be, well, okay, what if I need succession? I don't have it yet. You're going to need time to find that person and bring them in. We all know that number one, talent is the hardest thing to find in this industry right now. Finding that talent, getting them ingrained in your culture, getting them working with your clients, that takes time. So if that is a goal of yours at the end, right, when you are selling, again, thinking about this 7 years in advance, it's going to take that long to get that person in the door, get them trained up, and get them to a point that if you were to step out tomorrow, do your clients all feel very comfortable with that advisor that they're working with?
Yeah. So idea for another topic for us down the road, maybe. We've talked about the internal succession play. Generally speaking, there's a 38% discount in headline valuation. Our friends David DeVoe and his firm have done a lot of really great research on this. But we should also mention that that's typically a cash transaction There is no option for rollover equity in the buyer firm. And as we talked a lot with Bert just 2 months ago when we did this episode, part of the reason folks are transacting is to gain access to a faster growing equity piece. It's not about taking all the chips off the table. It's diversifying the holdings and gaining access to a growth stock. And internally, you're not going to have that option if your G2 is buying you out over a period of time. So that's probably one we should talk about here at some point in the future.
Yeah.
All right, so let's get into the first bucket. If we think of the 7-year runway as year one, which is essentially getting your house in order. Year 2 is the process itself. Years 3 through 7 are growth period or post-transaction growth. So why don't you take this first one? Let's dig in. So let's, as an example, I know that in 7 years I'd like to exit. Let's say I have a G2 and it's time for me to start getting my house in order so that when I do approach the market, I am as attractive as possible to the general buyer cohort. What are things that I should be doing in that first year to prepare the business?
Yeah, and one point of clarification too, you hit on it right now, and I think it's important to call out. In this 7 years, our transaction in this story is happening at some point in those 7 years, and there's always your retention and growth periods that are extending you out to those 7 years. So our 7 years in this example is, hey, I want to be retired and out of the business completely, have all the retention metrics already done, growth metrics already done by the time I retire. So if we say that 3 years of that, right, 3 to 4 years is your post-transaction growth, that leaves 3 to 4 on the front end. That's right. And so when we're getting our house in order, a lot of it is looking at your business and putting yourself in the mind of the buyer. That's typically how I would describe it. If you were a buyer and you were going to go out and buy a firm, what aspects to you are most attractive? You know, we get this question a lot of what drives valuation, what makes things really valuable. And it's really easy if you just flip it and say, hey, well, let's look at an example. If you had an advisor down the street that you wanted to buy, what aspects of that business are you looking for that would make this a really good deal where you say, Mike, I got to make this deal happen. It's a really good firm. And so when we're in that early phase, I think a lot of it is looking at your team. Do you have the right people in place, right? And do we have time to fill any gaps that we need to fill? Or, you know, maximize utilization of people we already have on the team so that when we go and have that conversation with a potential buyer, it is very clear how all of these people are rock stars, how they all play into the growth dynamic. Everyone has the role that they are playing and they're doing it really well. We've maximized efficiency. Our processes are really tight. We have that story when a new potential client walks in the door, they understand us, they know why we're different. So thinking through some of those things and really starting to develop your differentiators. What makes you different? What makes you unique? Why do your clients love working with you? And starting to develop that story. The other thing I would say is starting to look at your financial picture. I think a lot of owners, right? These are small business owners who there's a lot of benefits to that from tax and those sort of reasons, but they haven't really looked at it from the perspective of I might have to sell this and make this look attractive to a buyer, right? So when they've been looking at their P&L and their balance sheet historically, they haven't had to look at it through that lens. So I think starting to put on the lens of, okay, when I have a third party looking at these financials in a few years, what are they going to see? What are they going to call out, right? They're going to look at things like my margin. They're going to look at things like my payroll, right? And those sort of things and how, and just general top line revenue for the amount of assets I have. They're going to look at expenses, right? Are any of my expenses really out of line? Maybe right. I'm spending a bunch on marketing and I don't have really the growth to back up what I'm spending on it. Those sort of pieces, right, are kind of the pieces that I would start to look at. And again, just the more you can put yourself in the mind of the buyer, it helps. How is that story going to look? If you had someone trying to sell their firm to you, what are you looking for? What kind of things are going to jump out to you as either, wow, this is a firm we need to go out and get, and maybe what are some things, red flags or items that, man, I wish they were better in X, Y, or Z area. Yeah, what about you though? When you're looking at that, what do you think?
No, I think you nailed it. I'd add two things. I did a webcast the other day with Greg Johnson, our national sales director, and we were talking a little bit around true drivers of valuation. And some of it was just basic stuff like, hey, AUM does not automatically contribute to enterprise value. And you don't buy AUM, you buy EBITDA. AUM as a proxy. Oftentimes, it can be a poor proxy because it depends on operating model and types of revenue that are coming in and all sorts of other stuff, billing rates. But I think two things that as a buyer, I would really be interested in is one, have a business development culture built into the firm. And what I mean by that is if you look at RIAs, we have a growth problem in this industry. And I was at Inside Track for Fidelity last year, and there was a really great session where they sort of attribute a lot of this to, frankly, complacency. You know, when you look at 2008, 2009, we had this market dip. Folks took their foot off the gas. We entered this not took their foot off the gas on growth. It was just the focus shifted towards retention of clients. And then we shifted into this explosive bull market that essentially has continued unabated minus a few blips. And when the market is cooking, it's really easy to not focus on new client acquisition because you are seeing enterprise value go up essentially every quarter. Your billing rates are going up every quarter. So they attribute a lot of the lack of growth that most RIAs are seeing right now to just the founders not spending time on it. And historically, you know, we see founders spending less time on business development or new client acquisition than they have at any other point in their career. When they get into the business, they are hungry. They have to build something sustainable. It's their paycheck, not just, it is their paycheck. It isn't quite yet the career or the calling yet. So start building a process around getting new clients in because a firm that is growing for 1 year is valuable. A firm that is growing for 3 to 5 years and that trend line is increasing is more valuable. So devote time to that now. And then I think the second thing is have a thoughtful comp plan around incentivizing advisors to do what you need them to do. So if you are a growing firm and you've got 2 advisors, one is a hunter, they're out recruiting and finding new assets, bringing them to the firm. And you have another advisor that is a farmer and a servicing advisor, both extraordinarily important to the growth and the continued health of that client base. But the hunter is much more valuable for the growth of the firm. And since growth drives valuation more than anything else, there should be a comp plan in place that reflects those activities or incentivizes the right activities. So if I look at a firm and there's something unique there to where founders spending a lot of time on business development and that next tier or cadre of advisor is incentivized to contribute to the bottom line growth of the firm by recruiting new clients, and there's something thoughtful around whether it's equity or cash comp to support that, then I think that's something that we would be really excited about.
And I think where that's especially important, and especially in the context of this conversation, in our example, we're talking about advisor owner who wants to retire, right, at the end of that retention and growth period. If we know that going in as the buyer, to your point, growth is one of the biggest contributing factors to the multiple that's being put on the business. How is that growth going to continue when that person steps out? So to your point on building out the team that's all focused on business development, you know, one of the things on the back end that we're doing here as buyers is we have to go build out the FP&A model in our projections for the next 3 to 5 years. Well, we have to put a growth rate in there. If I know that the advisor stepping out and the main owner, and they have been the only source of growth, the go forward growth rate we have to project is lower. So even if it was a fantastic growth rate for the past 3 to 4 years, knowing that it was all focused on one individual who's going to be retiring and that none of the growth has been from the team, we have to take that into account. And so I think your point is even more important if you are looking to retire at the end of the transaction. Last episode, we talked about the average age coming down. A lot of advisors are selling early and staying on. We're not really as much focused there, right? This is more focused on the advisor who does want to retire after everything's done.
So, I mean, we've talked about, we have our own scorecard that we use to grade these deals when we sort of think thoughtfully around the valuation. And most of that is quantitative. It's the things we're talking about today: growth rate, client concentration risk, demographics. Do you have a niche market? Are you marketing to that market? But some of that is qualitative. And one of the qualitative issues that we've talked about quite a bit is just, we refer to it as founder risk. It has so much of the story been built around your personality and your ability to do something special or unique. It could be as simple as, I invest money better than anybody else. It could be something a little more complex, like I'm a voice on the local radio, and clients just know me. They don't meet my G2 advisors. My staff sort of sits in the background. There are things we look for through conversations that would make that a more risky investment for us to make if we think there is founder risk and that founder is going to disappear in the short term rather than in the long term.
You're 100% right. Yeah. I mean, you got to think about it. The reason buyers are paying these high multiples, if they just wanted to buy, let's say you're a $300 million firm. If you just wanted to buy 300 million, it was going to stay 300 million. It was just going to grow with the market. You definitely wouldn't be paying the high EBITDA multiples we'd be paying for that, right? What you're paying for is the return you're going to get from the talent and the individuals who are there and the growth that's going to come from that extreme talent that you're bringing on, right? So that's, I think, the mindset you have to get into is they're not just buying the book of business you have today. It's everything that can happen in the future, or the multiples just wouldn't be as high for those types of firms.
Yeah, you're bingo. I mean, we've joked about it, and I know this is a little bit facetious, but again, if there is no growth in that enterprise and you pay a 10x on bottom line cash flow, that is essentially a 10-year break even. That would be a ludicrous investment for most firms to make, unless they thought they could grow the firm out of that multiple. Because the other ways to make money in M&A are not so nice. So,
right,
which is not what we do here at Carson.
No.
All right, so let's talk about that second bucket. If the first bucket is getting your house in order, second bucket is one that obviously you and I spend most of the time in, and that's the process itself. If you hire representation, which to be very clear, we recommend, I am a big believer that you don't go into the biggest financial decision of your life, the greatest wealth generating moment that you will ever see, without some sort of expert opinion. And so if you go into this and you have some help, that process itself generally takes about a year, give or take, call it 4 months. But most of the time, you're going to hire a banker or sell-side advisor and then kind of walk through a process. And you want to talk about this, or you want me to kind of cover some of the basics? Okay,
go for it.
So most of the time when you hire a sell-side advisor, they're going to spend time getting to know you. So the things that a buyer's going to look for, all of the financials and the story, the narrative around your business and how you got to where you are today, that is compiled usually by either your investment banker or your advisor into what's called a CIM, or a confidential information memorandum. And that is essentially a pitch deck for your firm. That's a lot of work. I think most of the time when you and I see these, they are 50 plus pages with some pretty dense financials and thoughtful adjustments that are being made. And that's not an easy task. I'd love to say that all the bankers out there are going to put something like this together in a week or two, but it's just not realistic. It takes you a long time to gather that data. It takes the bankers a while to compile that and analyze that, and then come up with their projections that a firm like Carson could use to build a budget and a P&L around. So that process, generally speaking, can take a few months. But before that, you're going to want to interview multiple bankers or sell-side advisors. This isn't something where you just call one firm. You saw a deal announcement. Hey, I'm going to call XYZ firm. You want to make sure that the firm that you decide to go with is going to run a process that matches up with your end goals. And there are different approaches. Some folks run more of the auction process where bids are collected prior to a management conversation. Others maybe lead with the management conversation and then run more of the numbers or the data gathering. But you want to just make sure you have a really good idea that one, they're really good at the math. I mean, that's what you're paying for, is somebody that's going to help you put your best foot forward. They're going to sell you. Two, I would say make sure they have a really good handle on the market itself. I'm always a big believer that if you go to a banker's website and you look at the tombstones, that's, by the way, tombstones are the deal announcements that they usually post on their website. If you look at the deal announcements and you see 14 straight transactions all closed with the same person, they're probably not the most objective third party. So find somebody that's got some variety there. make sure they have a better grasp of the industry as a whole, not just one or two firms.
And then that's with their relationships. Make sure that they know everyone in the industry, right? They should have a good relationship with all the major buyers. That's typically going to work the best. And especially because they're going to have a pretty good idea in the beginning when they're listening to you and your desires and how you want this to go, and looking at your firm profile, they're already probably going to have some ideas of firms that will fit well for you. Ones that might not, right? And ones that are maybe in the middle of the road that we need to look at. So that's really the importance of going with someone who knows all the players in the industry.
Yeah, we talked about this with Jess Polito, actually, when she joined us from Turkey Hill. And I thought she made a great point. Just talking about how if you go to just pick any sell-side advisor, and every time it's the same 5 firms that they're introducing their clients to, that should never happen. With the way that today's market has become more sophisticated and the rise of these institutional buyers, there are now, roughly 24 of us that do this at scale year in and year out, and a vast host of another 40 probably that do this at a much smaller scale, but participate in the market. So you want to make sure that they're not using the same subset of potential buyers every time they go to market. So the next step, I think after you decide on that sell-side advisor, the investment bank, is they're going to then kind of kick off their formal process. So before they send that SIM out, they'll send what's called a teaser out to the buyers. And that is a one-pager that we would look at. It'd have some of the highlights of the opportunity. It'd have the project name so that would protect anonymity, and give a little bit of the flavor around why a potential firm like Carson would be interested in that opportunity. And then from there, we would sign an NDA that would be mutual. So that would allow us to share information, them to share information, if we choose to pursue or participate in that process. Once we do, go ahead.
That piece right there is really important. What I want the sellers to remember is that in these typical processes, your entire firm, right, all the metrics, everything is going to be summarized initially into one page. And that one page is going to is scary, and it's supposed to catch the buyer's eye, right? And the buyers are seeing a lot of these, right? We are looking at a lot of them. So when we talk about all those different metrics, your growth metrics and everything, I know sometimes it's easy to kind of, okay, well, I'll focus on a few of them. Remember what's going to go on your one page. What is going to get, because that is the first step. Is you could have an amazing story that if I got in front of you and we were able to spend a few hours together and have a meal together, I would be really convinced by the end. But just because of how typically this process works a lot of the time, it's going to summarize down to one page. It totally reminds me of like a med school or law school application, right? You're trying to put your entire educational experience and your personality into one page. So I just wanted to highlight that real quick. I think we sometimes jump over that, but it's a really important point that a lot of that hinges on how well can I show on one page.
Yeah, you're absolutely right. And I'm a big believer too that who you choose as a sell-side advisor lends credibility to whatever's on that page. So there are those firms that we work with that we know if we see a teaser or a SIM from that firm, that is going to demand our highest priority and a lot of time. And we know that that's a firm of integrity, and they do this all the time. They know the market. So select somebody that's going to represent you really, really well, because you are putting a lot of trust in that individual. So once they send the SIM out, let's just skip to sort of the offer or the LOI process. So multiple firms kind of go through 2 different major processes. One of those is the management call, which is essentially us getting that hour to 90 minutes on the phone with the seller to talk through all things Carson, all things their firm, answer any questions they might have, and then do a little bit of the speed dating question round where it's, tell me about this, tell me about that. And we're trying to get to the heart of what they're trying to accomplish with the deal. And likewise, we are trying to determine if they would be a good fit for the Carson family.
And this is where
I gotta be honest, that's one of my favorite parts of this business. I love that management call.
Completely agree. And it is something though, where this is where having done your homework, right? We're talking about this process. initially, when you're doing your research on firms that are kind of on your short list that you might be interested in and knowing more about them, because that hour phone call that you mentioned, I promise you, it'll be one of the fastest hours of your life. It'll go by like a blink. The more you're aware and familiar with the potential buyer, the more you can really focus on shining on your own business. Right. So I just, again, doing your homework, doing your research kind of prepares you for these steps in the process.
I think a red flag, if you are a seller, because the buyer should be doing their homework too.
Yes.
So if you get on the phone with a buyer and you start that call and they're asking basic questions that were either in the sim or available on your website or social media, that's probably telling you just how important you are to that potential buyer.
Yeah.
They should be putting as much care into a conversation like this as you would be. So I think that's great advice. We were talking just about how much we enjoy this, but one of the things I love about this business is there are infinite possibilities for how folks got to where they're at. And we will talk to people that were an executive at IBM before they launched their financial practice. There are those that right out of college went into a training program with Smith Barney or one of the wirehouses. We had one gentleman that we talked to that owned 2 pet shops before he decided to be a financial advisor. There's all these great stories about how people got into it. And this is at its heart, a people business and a relationship business. And I do think you can glean a lot about somebody in that 60 minutes, not anywhere near as much as you can when you get to break bread with them and be face to face. But I will tell you, there are deals that we have decided not to pursue after those 60 minutes. And a lot of those deals that we have the 60 minutes and we go, oh my gosh, like we got to do whatever we need to. Like this is somebody that would be just a wonderful member of the Carson family.
Yeah. And a lot of those times, hopefully the financials are good. We're basing that solely off the individual. Like this individual we want here culturally, right? We want them to be a champion on our team. We want them, wearing our colors because they're just a fantastic person. And that's usually Yep, I agree.
Yeah, early in my career, Greg Johnson, our national sales director, challenged me that one of the greatest tests of character is would you see yourself recommending this advisor to your parents to manage their retirement income? And there are oftentimes there's a resounding yes to that answer. There are times that it's not. I think there's a lot you can glean about a person's character just by how they carry themselves, how they answer questions, whether there's a sense of openness and curiosity as they approach that call, if they're engaged or not. I mean, right when you get on the phone, if somebody is zoned out and not really taking this seriously, that's probably not going to be the right fit.
I mean, that story is actually true. We were talking about doing a deal with one of our existing partners, and the idea around, just making sure, is this a person we want as part of, the Carson Wealth team? And I said, guys, when I got off the plane back to Omaha from visiting them, I literally put their materials, their plan and everything in the mail and sent it to my parents. And I was like, whenever you guys are looking for someone, this is the person, no doubt in my mind. And so I love that test. It's such a good test.
I tell people my parents are Carson clients, and I am a Carson client. And, I feel very confident that we've got the right people in place.
Yeah.
All right, so let's talk about an LOI. So you do the management. Let's assume that we fall in love with that firm. That firm selects us as one of the firms that they would like to continue in the process with. So at that point, usually the banker or the advisor would request LOIs. So they would sometimes send out a more formal data package. So sometimes there's just a SIM. Sometimes there's actually an Excel file that comes with that has the employee census and historical P&Ls and budgets and balance sheets and all of the mechanical things that a firm needs to do or needs to see in order to put together their analysis.
Yeah.
So we gather as a firm, and we have a valuation committee that meets and talks about this firm and decides what we want that offer to look like. We then submit an LOI, which is a letter of intent. And a letter of intent is generally speaking non-binding. That is a way for us to express our interest in pursuing a transaction. Now, one thing I want to mention, because I think we are a little unique in this, maybe unique's not the right word, but we're in the minority, is that when we put together an LOI, we intend to pay that amount. There are things that can come up in due diligence that would impact valuation, but often that is called retrading the deal or trying to renegotiate after an LOI is in place. We pride ourselves on making sure that the analysis is as accurate as possible going into a signed LOI, that we do not have to retrade deals. And we have sort of staked a lot of our reputation around honoring valuations because we don't have to make major adjustments to the operating model if we choose to pursue a deal.
Yeah, we're doing a lot of that heavy work on the front end going into our LOI versus getting an LOI out the door, putting the numbers on there that get you interested, and then making those adjustments and doing everything during the due diligence period after the LOI is signed. Yeah, our firm, we put all that work in up front.
And that's, again, why I think it's so important to hire sell-side representation, have somebody put this together for you or work on this for you. Your odds of having to go through a process like that significantly are decreased if you've got the appropriate party that's looking out for you going into a process like this.
Well, and especially because a lot of that stuff that they're sending over is actually the first round of due diligence that you're going to have to send in anyway, right? Because if we execute an LOI, we can jump into the next phase, which is due diligence. There's going to be a lot of information that you're going to have to gather and submit. You're going to be going through reverse due diligence with the buyer, gathering information from them, especially if you're getting rollover equity as part of that. And having representation during that period can be a lifesaver, even to the point because a lot of those bankers will have worked with firms from all the different environments, so they're going to have a general idea of, hey, this is the type of report they're going to want to see for XYZ, right? For accounts, for this sort of stuff, and they're going to be able to walk you through and help. In my opinion, actually, due diligence is one of the times where having representation helps the most.
I totally agree.
It keeps you sane. It keeps you organized, and it helps. It's another voice in the communication between buyer and seller that can help through that process.
Yeah. I mean, if you've got a great banker that's representing you to the potential buyer, you sign an LOI, you decide on the firm you're going to move forward with. Carson sends their due diligence request list. If you have the right banker, 50 to 75% of that list is already compiled and ready to go.
Yes.
So that whole financial undressing, we've heard it called too, like that going through the real in-depth review of the financials of the firm, a lot of that's already been done and accomplished, which makes your life infinitely easier.
Yeah.
So you decide on a firm, you sign an LOI, there's a whole integration and transition process, and those are really important. We're not skipping over them because they're not. We're just, the point of today is to talk about those 7 years. So that process itself takes about a year from the time you start going to interview bankers, you hire somebody, they compile your financials, they put together a SIM, you go to market, you interview everybody, you go through an LOI, and then you sign the LOI. There's a whole transition and integration process before you go live with the firm and then after you go live with the firm. So let's just call that a year for round numbers' sake. So we talked about it, or we sort of alluded to the growth after the transaction. So when we say your peak valuation, where you're going to still be around post-transaction for 3 to 5 years, why is that? What do we mean when we say that?
Because typically from every single buyer in the market, there's going to be 3 components to your deal structure. And there's going to be a portion that's paid up front. So that's when the deal closes. But then you're going to have 2 really important pieces, which are retention and growth. And so for a period of time after the deal closes, for the first period, you are going to be really worried about making sure that the revenue you promised was going to be there, that the buyer underwrote for is still there for a year or 2 years, whatever it might be for that retention period. And you remaining on board and you making sure those clients have a really good transition process is critical. Now, typically, like at Carson, we see a really good success rate on those retentions when the advisor is engaged and working with those clients. But again, this is going to be a year to 2 is just focused on the transition of the clients over. Learning the new processes of the firm that you're joining, learning all the things you can take advantage of. Because to your point, the third component of that is your growth component. All of these deal structures, when you look at the headline valuation, right? The headline valuation is going to be the upfront, the retention, and then, hey, there's this cherry on top, which is the growth, which is what can you do for a period of time after the deal closes. So you're still going to be trying to drive growth during that period, trying to maximize it. So you can make sure what you're trying to do in all these transactions, you're trying to achieve as much of that headline valuation as you can. And the growth piece is a big part of that. And I think if you try to cut it short, if you try to step out of the business too soon after the transaction, those pieces, retention and growth, are going to suffer a little bit because of that. Number one, you're the fearless leader of the firm, right? A lot of that culture revolves around you. Your clients, this is the people business, right? They're there because of you. They're there because of the trust they have in you. And typically the owner is one of the larger growth engines. We've talked about, hopefully they have spread that around and a lot of the other firm is ready for the growth, but they're still usually the champion of it. Even if they're not the one bringing in the new clients, they're the ones that are kind of leading the helm in terms of business development and having conversations with their team on how to do it. And so again, we went through the first year, we went through the next 3 years. So these last 3 years of the 7 years is typically going to be post-close. So you've done your transaction, but you're focused on retention and the growth earnout.
Yeah. So bottom line, the way business valuations work is you would look at a firm and you would project future growth. You talked about this in the FP&A model. By the way, for the average listener, you want to say what FP&A means?
Financial planning and analysis.
There you go.
Yeah,
so
most firms will have a department they're tracking all of these things post-close.
Yeah,
a lot of us get to work on the front end.
That we make. Yep.
Exactly. Yeah, and then hopefully it all pans out, and the investments we made, the firms we bought, perform pretty close to, if not exceeding, those FP&A models that we put together.
Right. So if we have a firm that's growing, let's say at 5%, net new flows, exclusive of market, and the founder is going to step out immediately, we would never put 5% into our models, which would then mean the firm is worth less to us.
Correct.
If the founder is going to be around for the next 3 to 5 years and we can get commitments to that and we feel really confident about that, then ideally that firm's not going to just grow at 5%, but with the capabilities and back office support of a firm like Carson, we can accelerate that. And when we accelerate that, we can share that sort of valuation creation with the seller of the firm, which means your firm is more valuable. Flip side of that, obviously, is the melting ice cube, right? If your firm is decreasing in assets, if you are more assets walking out the door than you're bringing in, then theoretically, your firm is worth less tomorrow than it is today. So growth solves everything. It is the central point of what we are looking for. Obviously, all the culture and qualitative things need to be there too, but from a purely economic sense, when we're looking at the value of a firm, growth is absolutely paramount, and you cannot count on that growth without the founder being around. So let's recap again. 7 years. Mike, you want to do it one more time? What are the 7 years we're talking about, and why does it matter?
Yeah, the first phase is getting your house in order, right? This first year, getting your house in order, looking at everything. It's really fact gathering, information gathering, looking at the market, looking at your firm, and getting it set up, right? Then you're going to have the 3 years of the process. So you're going to be going through, getting ready, finding bankers, getting all your financials gathered, going through the vetting process for your representation. Who do you want to represent you? Included in that is, once you have selected them, it's going to be going through the process with them, right? Making sure they have all the data to get that SIM, working with them, and then going to market and going through the process of kind of selecting and honing in on the correct buyer for you. Post that, right? And then your final 3 years, 3 to 4 years, are going to be post-close, but executing on the retention and growth components.
That's right. All right. I think we did a pretty good job. We kept it 43 minutes. That's not bad, right? For us,
No.
This is sort of the lightning round for us.
Yeah, that's an hour shorter than I expected. So we're doing pretty darn good.
All right. Well, to all of our listeners, thank you so much for joining us. Mike, as always, it's an honor and a pleasure to work with you. This is always so much fun. So
Likewise.
Can't wait till next month.
Agreed.